Okay, hello and welcome everyone. My name's Tim Graham. I'm the Chief Operating Officer here at Reventon. Thank you for joining us today on our webinar, What's in Store for Residential Real Estate in 2022. What a year in real estate it was for 2021. I think if you spent about $500,000 on real estate in anywhere in Australia last year with the 20% that we got nationally, you would have made 100 grand. So just think about what you would have made if you had to put it in a good area. Okay, so we're going to talk today about a bit of a recap on what happened last year, some learnings that we can have from 2021 to carry us into 2022, along with some big predictions that we've made for this year. Today, I'm actually joined by our CEO, Chris Christofi, who is our the founder of Reventon. He's also an Amazon bestseller, selling author of his book, Your Path to Wealth, Brick by Brick. Anybody who sticks around to the end of this webinar will also get a free copy of that as well. And the thing I'm really excited about for today's webinar is that not only is Chris going to give you a copy of this book, a step-by-step guide, which will tell you how to invest, but something he's never done before and something I don't think I've seen on a property webinar before is that Chris has actually put this into action. Back in 2017, we started to document this exact process that Chris uses and that the Reventon Formula that we use for all of our clients, where he's actually going to go and show you every property that he bought since 2017 using this exact same process in the book, the exact same locations we've invested with our clients, same builder, same everything that we can do. He's gone and documented every one of those purchases, and he's bought 14 properties since 2017 using this exact formula. We're going to show you what they're worth today, show you the amount of growth, show you the amount of income that these properties are producing, and obviously show you where we can do this exact same thing in the future. So today we've got the five subjects we're going to cover. The first one being why invest in real estate in the first place. This is Chris is going to take us through essentially real estate 101. What do we need before we even think about buying real estate? Next, we're going to talk about that Reventon formula, the 8 steps that are involved in the formula. We're going to do a residential market recap on 2021, some of the challenges that Reventon saw in the market in 2021, including huge construction increases and things like that. And then we're going to talk about my predictions for 2022. I'm also going to give you a free giveaway, which is a book that we've published, which is a hotspotting guide. So how to actually identify these locations for future growth. So you can actually start to do this research on your own. Going to give you some free websites where you can get some great data. And at the end, we're going to recap and talk to you about how Reventon might be able to help you with your steps moving forward. So before we kick it off, we're just going to say, everyone, grab yourselves a pen and paper. We're going to be here for about 40 minutes today. We don't want to take up a heap of your time. You will have an opportunity, obviously, to book some appointments and ask more questions at the end of it. But without further ado, I'd like to introduce you to Chris Christofi. As I said, Amazon bestselling author. He's also an owner of 11 different companies. He's very, very passionate about real estate. I'm awfully happy that he's been able to put aside some time to actually share with you today his story. So without further ado, I'm going to hand it over to you, Chris. Thanks for joining us today.
Absolute pleasure, Tim. I'd like to welcome everyone and thank you very much for joining us. We're going to go through as much content as we possibly can to arm you with as much information. Why real estate, a bit about our retirement, our financial planning, but more importantly, to get us in the right mindset to be able to acquire wealth. So without further ado, let's get into it. And I'm also going to show you, everyone's going to get a copy of my book, Your Path to Wealth, Brick by Brick, which is an Amazon bestseller in 3 categories, which depicts exactly how I've helped over 3,000 Australians get into the property market. And I will also show you that not only we give great advice, we take our own advice and what it looks like in action, as Tim mentioned. So I think I always start with this: creating wealth or building your property portfolio doesn't start with money. It starts with creating the right mindset, understanding your numbers and understanding money before you can attract buying the right properties in the right areas. So a simple thing that I tell everyone to understand is money maths. Every dollar saved is like $3 earned. So I'll say that again, every dollar saved is like $3 earned. So when you earn money, you've got to pay tax, mortgage, living expenses, lifestyle. You might be able to save $1. Now, a lot of people that I know and the clients that we see spend more than they earn, which is very hard for them to save money until they meet us, of course. Then we make them very aware of their financial circumstances and how they can save. So money maths is important. Creating the right mindset to be able to acquire the wealth. Now, what do you need to invest in real estate? You need 2 things. You need equity or a deposit, which you can either sell down an asset, you can use a primary place of residence. In some cases, we've seen clients borrow money, go co-guarantor, their parents have helped them get into the property market. And also they need an income to service it, up to 100,000. That's a case-by-case basis. Now, if you don't have these two, that does not mean you should not start that conversation. It's never the wrong time to start a conversation because there might be options available to you that you don't know. But also there's a service that we started called Rev Money, which educates clients on getting to that point quicker. So instead of taking a year that it might have taken you, by having the right knowledge and the right safety nets in place and understanding money maths and foundation, you might be able to do it in 6 months. So it all starts with a friendly conversation. So no matter where you feel you're at, please, I encourage you, make sure to have that conversation always. Now, bear with me. For those of you who know me, I am technically challenged, but I'm a lot better at real estate, investing, and talking to people about where to invest. Now, everyone's heard the good old adage, the good old Australian dream. Pay off your mortgage, be debt-free, don't use credit, and you'll be fine. Now, that advice is what's leading 85 to 95% of Australians broke. That advice is broken. It's very, very important to understand the difference between good debt and bad debt. And I'm going to talk to you a little bit about that. And also to be conscious of what you need in retirement. Now, there's no wrong or right to this. Certain people want more money in retirement. Certain people want to retire sooner rather than later. If you're an extreme case like me, I'll retire when I expire. But it's I guess it's going to work because you want to, not because you have to, is the key here, and using time to your advantage. So if we look at an average retirement of 65 when people retire, if we look at life expectancy, for a male, it's 81.5, for a female, it's 85.4. I'm going to use 85 as an average. So you'll be retired for 20 years. How much money will you require in retirement? Now, the average pension is $37,000. Now, let's assume you've paid off your mortgage, which a lot of people haven't at that stage, but let's assume you have. You're still going to have bills. You're still going to have cars, insurances. You might want to go to restaurants. But what people don't factor in, if you're not working 38 hours a week, 40, 50, whatever it is you work, you're going to have more time on your hands, which means you're probably going to want to spend more money. So it's very important to start planning on how you can come up with that money. Now, 37,000, I don't think it's much money when you consider you've worked hard all your life, you've paid tax, you've paid off a mortgage, and here's a bit of money. Now, that's if the pension's still around. Now, that's means tested. So the longer that goes on, the less and less chance and likelihood that pension will be there. But a very important case that I tell everyone, I don't want my retirement to be in the hands of anyone other than myself. So 37,000, if you can get a good luck, I don't think that's much of a great retirement. 4% of people will retire financially secure, and only 1% of Australians will retire wealthy. What does financially comfortable mean? $62,000 a year. Now, as I mentioned before, having all that extra time, I don't know what sort of a lifestyle that would live. If you want to travel, if you want to go to a restaurant, you probably have to go on a cheaper day. Movies on Tuesdays, it's half price. You have to be very conscious of your money if you're on 62,000. We've actually done a lot of calculations over the years, and what Reventon recommends that you'll need in retirement is approximately 90,000. Now, if we use a 20-year period, in your retirement, you will need $1.8 million or $90,000 after tax coming in per year. That's to be comfortable. Now, I always ask my clients this question: do you feel you deserve a comfortable retirement? And if the answer is yes, and I hope it's yes, what are you going to do about it is a more important question. Nobody cares about your retirement or your money more than you. So your actions need to be aligned with that thought. And I always say that to people. Now, I want to give you a few examples about real estate and how it works and why it's such a powerful tool. First of all, it's a leveraged product. So if you buy a $500,000 property and you put 20% deposit, that's 100,000 plus setup, but let's use 100 for the round numbers. You're actually getting growth on the full asset. Even though you've only put 20% down, you're getting growth on the full amount. And that's what really makes your wealth compounded when you multiply this over and over, which I talk about in my book. Now, if you bought a $500,000 piece of real estate and it grew at 6%, that's 30,000. The following year grows 31.8, and it compounds and compounds. So within a 5-year period, you've made $131,000 in capital growth. So your $500,000 assets now 600. Not too bad. Imagine if you bought 2, 3, or 4. Now let's look at that property renting at $450 a week, which is about 4.5 to 4.6 return, which is not a bad return at all. And it's 3% interest rate. So it's costing you $12,000 a year in interest and making you, as we said, 23,400. So you've actually got about $12,000 left over. What would you do with that money? A lot of people say, Chris, I'll put it on my mortgage, I'll invest it. Now that's the answer that I like hearing. Expanding your lifestyle, I hope I don't hear that much because I want you to achieve your financial retirement. Now I want to use that example. If you use that, which we advise a lot of our clients to put that in their mortgage, let's say you've got a $700,000 mortgage and you ought to use that spare, and you ought to use that spare $1,000 in your mortgage you're going to save 10 years on your mortgage over a 30-year term, which is about $127,000 in interest. Again, knowing your numbers and putting that money in the right area, getting your money to work for you is so important. I know I skipped a slide now. If I go a few slides, guys, I apologize. I am technically challenged for anyone that knows me, but I do love and know real estate very well. Tim, I know you're laughing at me, so you can say something. Go on.
Every webinar this happens, every webinar.
Yeah, so as I said, technically challenged without a doubt. Now, how do we buy an investment property? We use the equity from our own home. We use that. So in this case, we buy an investment property worth 500,000. We use 20% deposit. That property, as I said, brings in 23,000, costs us 12. For using that rental income is what can really pay off our mortgage much sooner. Now, this is why I brought this up a few times, because by using that money, it's important for people to know that if you're to get a $400,000 mortgage, you need to pay interest over a period of time. So for the first 10 years, all you're paying is interest. You're not paying principal. And what's very important to note, what do people do in the first 10 years of having a mortgage? They buy a bigger house. They buy a car. They travel. They spend more money. Now, it's usually about 2.5 to 3.5 years people refinance their loan. Now, if you do that, what happens is you go to the start of the 30-year period again. 3 years later, start of the 30-year period again. So you don't really go forward financially. But what we are doing is using the most valuable commodity we have in our life is time. And we're wasting that by not investing. But more importantly, by not being conscious of what's happening by keep refinancing our mortgage. That's a very important note to make. Now, if you look at, there's over 10 million dwellings in Australia, and there's about 2.2 million property investors, which represents about 20%. Now, those figures were a report that was done in 2017 to 2018. That report the results were released last year. Now, the moral of the story is not many people own multiple dwellings, which means they will not have enough money in retirement, which supports the fact that 85 to 95% of Australians won't have enough money in retirement. One property is not going to be the silver bullet. 2 or 3 will get closer, 4 or 5 will pretty much get you there. But not many people have 4, 5, 6 investment properties. Now, investing in property is the safest and most secure way for your future. Now, I say this and I use a bank as an example. What does a bank do? They go, Chris, pretty funny. It gives out money. I said, no, a bank actually assesses risk. No one assesses risk better than a bank. So if a bank's willing to give 80, 90, 95% against a residential piece of real estate, it says it's safe and affordable. And nothing everyone's heard this saying is safer than bricks and mortar. That's why I have a lot of my money in real estate, most of my holdings in real estate. Now, Tim mentioned before the Reventon Formula. So for everyone who get a copy of my Amazon best-selling book, which depicts exactly this step by step. Now, I'm only covering certain aspects of that because due to time constraints, I can't cover it in the detail that we want. But when you come into our office or we meet you in Zoom, we can tailor make this exact principle and formula on yourself, but I'm going to show you it in action in a second. But just to give you a very quick bullet point of each step, the blueprint is step 1. Step 2 is the foundation. Step 3 is bricks or sticks, selecting an investment. Step number 4 is partnering up, finding the right team. How do I know what the right team is, Chris? One with a proven track record that lives and breathes what they say, but more importantly, that puts their money where their mouth is and puts it to test, which is why I've put what I've done and I've documented in 2017 to show you exactly how it works. Layering the cornerstone, applying the mortar, and brick on brick on brick. Now, it's fantastic to get a great strategy, but we need to keep building on that strategy and ensuring that we can buy a second, third, and fourth property. Now, it's why we deal in properties that are $400,000 to $700,000 in purchase price, because they've got great rental yields, not very high debt. We can mitigate our risk, and it's quicker to go to market a second, third, fourth time. which is exactly the strategy that I use to buy 14 properties. Now, this isn't all my property holdings, but I've documented the ones I specifically bought using the Reventon Formula and through the exact property builders that we use, the areas, locations, prices. Now, before we get into that, I know I mentioned money mass before, and I'm going to mention it one more time. For every dollar saved is like $3 earned. Now, I want to relay that back to our mortgage and see how that impacts people. If you go to the bank and you take a $500,000 mortgage out, over the 30-year period, you have to pay interest. Now, I'm going to keep it nice and simple. $250,000 worth of interest, $750,000 in total. Now, you've got to work, pay tax. So you must earn 1.5 million to pay 750 to square off 500. Remember, we said 3 to 1. So that 500,000 mortgage represents any debt. You have to pay interest on debt, and you've got to earn money, pay tax to pay the interest. Hence why it's important to save and put it in the right areas. Now, Tim, who will be discussing this in detail, Tim is our COO. He's been involved in real estate for over 10 years and traveled the world, has an MBA in business, qualified in real estate and the mortgage broking as well. We'll talk to you about property cycles and why they're cyclical. And he's also head of research. Property cycles are cyclical. So if you're seeing, which means they go in cycles. So if you're seeing a property market that's absolutely boomed and done well, you're probably too late. So want to enter the market when you look at the property clock, around about 9 o'clock, which is a rising market. Now, how do we know when there's a rising market? We look at the forward indicators. We look at why it's going to be a rising market. What is it underpinned by a diverse economy? Now, we look at a theory we call PIDE, population growth, infrastructure spending, employment, and diversity of economy, which is exactly what Tim's going to cover. So there's 3 things that we do when we look for property. Number 1, we go through a Reventon checklist. This is a Reventon approved property. Tick. We stress test all our thinking with independent research. But the third test, which I think is the most important, would I personally put my money, invest in that area? Would I recommend my family and friends to invest in that area? That's probably the most important test. Do you put your money where your mouth is? So when you speak to any professional, that's something that I hold very, very important in anything that I do. Do you have a proven track record? And do you believe in the advice that you're giving? Well, there we go, Tim. I wasn't that bad. Where are we? Now, some of the areas that we've sold, and he's laughing at me, but that's okay. Some of the areas that we've sold and helped over 3,000 Australians, different areas in Australia. Why in different areas? Because as we said, the property markets are cyclical. We want to get the forward indicators so we can get the market at the right time. Melbourne might outperform Sydney. Sydney might outperform Melbourne. Adelaide might outperform Perth. Whatever the case may be, we want to be there for a particular time. Now, what I'm about to show you here represents where we've sold real estate in the last few years. Western Australia, Adelaide, Melbourne, New South Wales, Queensland. So all of these areas where we've sold. Now, we've sold hundreds of properties, 3,000 since inception, which is 2005. Now, the red dots there is where I've personally bought property on the back of our research. So if you look at a lot of my property holdings that I'm about to show you, which I did the whatever Tim calls a documentary or a little test on the Reventon Formula, Southeast Queensland, Ballarat, and Geelong. What I'm about to show you now, and I'm very happy to show you this, is exactly the purchase prices, the entities, how much they're currently worth, how much rent they're bringing in, but more importantly, does everybody remember how much we need in retirement? Over 20 years. Tim?
1.8 million.
90,000 a year or 1.8 million. Now, let me show you what I was able to achieve without working 1 extra hour through using passive income and implementing the strategies that it's taken me almost 25 years to put together with a group of professionals that are the best in their field. Now, what you're looking at here is from the first property I bought in Geelong to 2017 to the last one that I bought in 2020. So it's actually over a 4-year period, but we're looking at the growth over 5. So just to not complicate it, that's over $2 million, just under $2.1 million in capital growth through bank valuations. Now, if you look at the income that's brought in as well, is $375,000 in rental income per year, just through these asset holdings. 221,000, you're in the top 1% of Australian earners. This is passively without me doing anything. After all expenses are paid, a positive cash flow of $189,000 a year. 90,000 is what we said is a comfortable retirement. These properties bring in 189,000 a year and have grown over 2 million within a short period of time. So I know, Tim, you always like to compare when we look at tables and discuss that, but you've been by my side since I've been buying these properties, and I told you that I want to look at this process because nothing shows you believe in your product more than putting your money where your mouth is. And I think that's a testament to that.
Yeah, as I mentioned, I was really excited to see this because I've never seen anybody else do it exactly like this. I obviously watch a lot of these webinars myself, as much as people that are on here today probably do as well. And I think it's actually a really important thing that probably shouldn't be looked over by people is that if you're chatting to a so-called expert or a property, specialist or a mortgage broker or whoever it may be that's meant to be a specialist in their field, are you asking these people the question, where do you own real estate? Who do you buy real estate through? What locations have you bought them in? And something that I think the team at Reventon are incredibly proud of is not only are we able to find people real estate they make money on, but when we're telling them about that, we can say, I'm going to be your investment next door neighbour. We literally buy in the same locations. The whole property team here all invest in real estate in the exact same locations we recommend to our clients. Chris has just shown you here, and Chris, I wouldn't mind you even bringing that back up, or actually I'll bring it up on screen for a second now. Those figures again, just have a quick look over the screen again and look at the purchase cost here. So what Chris has done is he's bought properties within the 450 to 700 bracket, right? I don't think you'll see one on there over 600 actually. Now what that means is he's targeting an area that's affordable, right? The incomes in the area will allow these properties to jump very quickly, okay? We look at areas like Geelong, and we're about to touch on an example of something we've done with a client here, where a lot of our clients that have bought in Geelong, we've got to that $800,000 value, and we don't see this market jumping from 800 to a 1.2 or anything like that anytime soon. The incomes in these locations have allowed us to get to that stage very quickly, but we don't see them jumping forward, in leaps and bounds over the next couple of years, which means it's probably the right time for us to start to unload some of those properties. Chris, I might steal one little piece of your thunder here and just move on to that side, because it's sort of what we're talking about now. But Stephen Rosie's a client that Chris worked with. It was actually featured on Sunrise TV at one stage. When they first came to us in 2016, they had quite a bit of credit card debt. We had to roll over some debts into the home loan. Then we helped them restructure everything and save them a fortune on the loans. But more importantly, we're able to get them into an investment property without it actually costing anything out of their hip pocket. Now, very quickly, we got growth in that property and we bought a second property. You fast forward 5 years later and all of a sudden we've got 430,000+ in capital growth. And we're doing 6 monthly reviews with our clients. And at this point is when we say to them, look, we can see that you've still got a little bit of debt on your own home. How would you feel if you went to sleep tonight without any debt on that on your owner occupier? And the answer for a lot of our clients is they'd sleep much better. So in their circumstance, we sell one investment property, the Geelong one, which has got good growth, wipe out their owner occupied debt, and then we're now debt free on our own home, and we can actually leverage off that home again to buy tax effective investment properties again. So we sell down one, we're debt free on our own home, and we can invest again. So Chris, that's one of my favorite client stories. We've got thousands of these types of examples, but what I love is, with Stephen Rosie especially, the position it puts them in to not have any debt on their own home is unique.
And it's very important to note as well, Chris, you might be on a higher income, you're a CEO, but getting all of our knowledge to expedite your process to get into the market quicker is so important, because the first property is the stepping stone to your second, third, and fourth. Now, even for people that have $1 million borrowing capacity, imagine buying 2 properties in different areas, which mitigates your risks, has a higher rental return, a better depreciation, but also you're more nimble to catch that 9 o'clock mark on that property clock. So there's so many advantages, and I've just demonstrated, no matter if you're on a higher income or lower income, this strategy works. It's low risk, maximum returns, and as we mentioned before, nothing's safer than bricks and mortar. We've helped so many clients in all different situations, you name it, we've helped them through using the exact methodology that I've just proven to you not only works, that we follow ourselves.
Yeah. No, I think it's really powerful, Chris. I appreciate you sharing that with us. We're going to move on to a bit of a market recap on 2021. As I mentioned at the start of this, obviously a tremendous year in real estate, but it didn't come without any issues either. It was quite a big boom in property, but obviously we had some challenges with that. So we'll talk about that in a moment. But despite the ongoing impacts of COVID-19 last year, every capital city in Australia actually experienced double-digit growth. We often talk about, property markets being resilient. We've just gone through a pandemic. This market wasn't resilient. It was actually a boom. We've, far surpassed that. So if you have a look at this, we've got Hobart leading the way last year with 51% growth in 12 months. Canberra saw an increase of 44%, while Sydney and Brisbane grew by 36 and 31% respectively. Melbourne experienced 25% growth, even though we were locked indoors and couldn't attend any auctions or go out and actually inspect any real estate. Somehow we still managed to get 25% growth, which is pretty remarkable. Adelaide close behind that with 23%. Perth and Darwin are more modest, 18% and 12% respectively. So double-digit growth is a pretty incredible feat. And I dare say most people are sitting there going, well, have I missed the boat? I didn't buy in 2021. Have I missed the boat? Am I going to miss out and not be able to get into the market? The answer is no. Chris just touched on this. Markets are cyclical. Every one of those properties that Chris was looking at, there was in that 450 to 650 bracket. We're going to talk about some areas today where I can still replicate that, and I still believe I'm going to get 20% growth in these markets. So the answer is no, you haven't missed the boat. You've just got to be more creative in the areas that we look. We'll touch on some of these areas in a moment, as I mentioned. So predictions for 32% decline. Who said that? It was the big four banks. I remember towards the end of 2020, the big four banks all gave their predictions for what 2021 was going to look like. And, they range from apocalyptic to dire straits. Back in 2020, Westpac and ANZ both gave 10% decline expectations for the national market. NAB predicted 15%, and the Commonwealth Bank, not to be outdone, expected 32% declines. Now, we just sort of touched on what happened in every capital city. The national market actually grew by 20%. So, not only did they say 32% declines, but they missed out on the other 22%. So it's 52% swing in the wrong direction. So I don't know how they managed to do that, but they're at it again. The media gets paid to sell papers, and out now they're talking doom and gloom again. So as an investor, you need to be able to understand some of the information that you're reading and see, is there actually any benefit to taking this on board. So look, one thing that we would touch on in 2021 year is that, whilst we had an enormous housing boom, we also saw a home building boom, and that came with, quite a few challenges. Number one being construction costs. So between mid-2020 and March 21, the Home Builder Grant offered $25,000 to home builders. You couple that on top of some of the already existing first home buyer grants, and you could get up to $45,000 in government grants to go towards your new builds. And the idea behind this was it was meant to stimulate the construction industry, but instead what it's done is it's actually created even further supply chain issues, which we already had. We've got massive shortage in building supplies worldwide, and coupled with natural disasters from a few years ago with the bushfires here, and it's put a lot of pressure on builders. So these have led to construction cost increases of 15 to 30% in 9 months. So what does that mean? Does it mean we don't new build anymore? It doesn't mean that. What it means is we have to be very, very smart about the contracts we get into. And I'm fielding phone calls every day now from clients who've gone out and bought properties on their own 12 months ago, where builders, and I won't name them, but even the main papers yesterday, one of Australia's largest builders came out, and they're putting prices on fixed price contracts up between $50,000 and $200,000. Right now, most people say, how can they do that with a fixed price contract? And the answer is, they can't really. They just have to either give you back your deposit, or you say, okay, I accept it. If you don't accept it, you've got to re-enter the market again. Yeah, you'll get your deposit back, but you are really starting again. And it's because the builder can't wear those price increases. So unfortunately, it is just a state of the nation. And in fact, it's a state of the globe that, the cost of construction has just become so significant that, builders are going bust left, right, and center. So what does that mean for you as an investor? There is still some really big benefits to buying new. Stamp duty concessions, depreciation, modern appliances and tenant appeal. All these things make it worthwhile doing that, but you've got to get smart about the types of contracts you get into. Chris, we've done thousands of these builds, and something that you and I talk about a bit is that, outside of, picking a builder and knowing that they do a good job, building your home, but understanding the contracts a conveyancer will only look at land versus land. So they'll actually help do the conveyancing between you and the land vendor. But a misknown fact is that most conveyancers actually won't even review your build contract.
That's very true. And I'd like to touch on a point that you were mentioning before about the big banks predicting property markets going down. We were actually saying, so if you go back to some of our old podcasts that we've done with property experts, property analysts, we were predicting the market to have a big boom. Not only were we predicting it, action speaks louder than words. You can actually see how active I was in the marketplace, in the markets that we're recommending for our clients. If I had $1 for every time I heard the markets can't go up again, it's not going to go, as I mentioned, I'll be richer than Elon Musk.
Yeah.
It's important to take action and not listen to the people that are there to sell the media. So we were taking swift action. And further to the point that you just mentioned now, Tim, it's important to be working with the right builders and to have a team of experts behind you that can navigate through this time. And I'll be the first to admit, we are entering unprecedented times. I've never seen since 1999, I've been in real estate, with all the construction costs going up, with the growth that's happening. I've entered the market you need more knowledge now, you need the right people behind you. I've never seen growth like this, 22% across most of the national average, but also the construction costs. This is unprecedented times.
Yeah. Look, and it's probably worthwhile mentioning that, for some people, this might put them off new build. And look, I think there's merit for both. And we obviously help our clients buy established or new build. It's completely up to you. But one thing I would say, which again is probably a common misconception, is that they think that if I was to buy a property that's established on the market today, that might be faster and I'll limit my risk. The challenge that you have right now, and I do a lot of buyers advocacy work for established properties as well, is that in order for you to get into the market right now with the little amount of supply that's actually on the market, you're likely going to have to pay over and above what the property's worth to get in. No one likes paying too much for real estate, but I can tell you bargains are very, very few and far between. How many of you have gone out there to an auction recently and been blown out of the water by properties getting sold $100,000 over the reserve price? I'm hearing it every day. So don't think that if you go and buy something established that you're necessarily going to be saving yourself money. You're going to pay more in stamps, maintenance, all these types of things that you can still have. So it really is important not only just to pigeonhole yourself into one type of product type, but understand based on your goals what the most suitable investment would be for you. So we're going to move on to some other probably less known challenges that have come about in the last year with 2021. It comes down to valuations. Okay, so off the back of the construction costs, the less publicized consequences of the building cost increases is that people are actually having valuation challenges. Valuation challenges have been existent in new build for a long, long time. And this comes down to the GST component, it comes down to the lack of comparables, but now more than ever, it's actually very lucky that we have had such a boom in land value, but the value is going out and saying, look, I want to have a look at this property and tell you what it's worth. They have to compare it with a product that's established and it might be 12 to 18 months old. Now, if I'm building a home in 2022 and comparing that to a property that I built that was built in 2018, the price difference is going to be staggering. So what we're having is we're getting calls from clients that have gone out there and again bought these properties through a retail builder on their own, and they're saying, I've just had a valuation shortfall of 50 grand, 60 grand. Now, the good news is, we have a tremendous finance department here. We've got an incredible client services and contracts team here. We've been through these things before. We can help our clients and anybody that's on the call today that might be experiencing this. We can help people navigate these uncertain times. We've had clients that we've helped get out of contracts. We're helping them find new builders. We're helping them negotiate with builders to make sure they get the right contracts in place. These are all the types of things that you need to be looking at if you do end up with a valuation deficit. So it's something that's not really publicized in the media all that much, but I'm hearing it more and more. So again, there will be an opportunity at the end of today's webinar where you'll get a QR code if you want to have a chat about these types of things, or if you're looking to get into the market and you want to understand this a little bit more, please take advantage of that. There's obviously no fee for our meetings or no obligation to proceed, but it's really, really worthwhile understanding this because only with this information can you make an informed decision. Cool. So, Chris, we're going to jump into talking about my predictions now. I might sort of throw to you in a minute to get your predictions as well. But for me, I'm a really big believer that the regions are here to stay. You and I have been in the regions since 2014. We saw the writing on the wall back in 2013-14 that a mum and dad that was buying an investment property here in Melbourne or looking at Sydney we could see all of the approvals coming through for new build and realize very quickly, this is not where people are going to make money in real estate. There's going to be an oversupply. A lot of these properties are getting sold to foreign nationals overseas. There's going to be very little opportunity for growth in these markets. So what we started to look at was, how can we still spend the 400 to 500 bracket back then, but get ourselves a land component and get something that will grow. And that's why we focused on your Geelongs, your Ballarats, your Sunshine Coast. Now, the people moving into these areas and people investing in these areas, it's due to the affordability and lifestyle factors. Okay. Now, this was happening well before COVID happened, but if COVID has taught us anything, it's that we don't have to live in the CBDs and live in the capital cities now to still work. So what's happened is the regional areas have become incredibly popular, and I believe that's here to stay. I don't know if you agree with that as well, Chris, but the regions, in my opinion, are still showing the best affordability and the strongest rental yields.
100%, but also more importantly, we've mentioned this before, and I say this statement and people go, Chris, that's crazy. $400,000 to $700,000 with a good underpinning factors like employment, like the pipe thing we said, is recession proof. People go, how do you say it? It's recession proof. People still need to live somewhere. People still need to invest. It's got high rental yields, great tax deductions. And in any market, we've seen that they're very stable in their prices, but also growing a lot exponentially, which is why we've got to go, obviously now we're looking for the next Geelong, so to speak.
Yeah. So look, my recommendation is look outside of the major capital cities, okay? Find value in the smaller cities. That includes regional and some of Australia's smaller capital cities. Yeah. Don't follow the masses. As I mentioned, I think I hear this every day. I'm talking to investors and they say to me, look, I really want to find something in Brisbane. And I say, why do you want to buy in Brisbane? And it's because they saw in the media that Brisbane's going to boom and the Olympic Games, and their friend at a barbecue bought in Brisbane 12 months ago and made money. Well, the friend at the barbecue, they bought at the right time. They bought 12 to 18 months ago. The markets are cyclical. If you're trying to enter the Brisbane market right now, in the established market, you're going to pay a premium for the product. In the new build market, you're going to be waiting a long time for the land registration, and you should expect some delays as well. There's a big shortage in things like the engineering pipes and that for sewage and things like that. So there's a lot of challenges in that Brisbane market, not to mention the poor floods the poor Queenslanders have to have this week. So there's things like that I think, don't follow the masses. Use your research. I'm going to be talking to you now about a couple of areas that we're highlighting. I'm also going to talk to you about a couple of free websites that you can use that will help you with your predictions. So the first one that we want to talk about is Bendigo. Okay, similar to the Geelong and Ballarat story, Bendigo is on the $5 billion regional rail link. That opened in 2015. Now, that brought Geelong, Ballarat, Bendigo much closer to Melbourne, but that's not the end of it. By 2029, it's going to be on a direct line to the Tullamarine Airport, because we've got, here in Melbourne, we've got a train station that's going to go from the Southern Cross station out to Tullamarine, and that goes via Sunshine. There's a super station at Sunshine, which is where the regional rail runs through. So the future of Geelong, Ballarat and Bendigo is extremely strong, and I still think we've got some great value in the Bendigo market. In addition to that, we've got a $630 million Bendigo hospital redevelopment that is now complete. That was the largest health infrastructure project in Victoria's history. Got a $1.3 billion Australian Defence Force contract up there as well. It was voted as Australia's most livable regional city by RMIT. It's got one of the lowest unemployment rates nationally, and Bendigo's population is expected to double by 2055. So what does that mean to housing? It's going to put a lot of supply issues on housing. That's why we need to add to Bendigo's roof lines, and that's why I'm saying for that particular location, especially in the Northern Pocket, we've got a new train station opening. Bendigo is still offering very good opportunities for capital growth, and we can still get very good rental yields there as well. The second one, and again, I will mention if anybody wants more information on any of these areas, we've got some terrific location reports. Do reach out at the end. I'll be more than happy to share them with you. But the second location is Adelaide. Okay, I think there's a lot of property analysts over the last sort of 5 years talking about Adelaide. Again, thinking about that property clock, I didn't believe it was quite an emerging market yet. Now I do. Okay, Australia's most livable city. They knocked us off the perch here in Melbourne a couple of years ago. It's the third most livable city in the world as well. There's an $11.9 billion infrastructure project or infrastructure projects currently underway in South Australia at the moment, which is leading to one of the largest interstate migration booms of over 30 years. We've also got a $550 million new women and children's hospital being built there, a $40 million redevelopment of the CBD, $535 million redevelopment of the Naval Precinct, which includes a couple of massive contracts to the US for submarine builds. And then we've got one of the strongest rental yields and lowest vacancy rates in the country. So again, if you want to start to understand what we're talking about in these vacancy rates, median price rise increases, do yourself a favour, write down this, grab yourself a pen and paper, SQM research, look for vacancy rates. Right now in the suburbs of Bendigo, you'll find vacancy rates under 2%. In the suburbs of Adelaide that we're highlighting, in areas in the northern pockets around where the new train stations are going there as well. There's literally my last couple of purchases in Adelaide, we've got a vacancy rate of 0.01%. Chris, have you ever heard of vacancy rates of 0?
Tim, I just grabbed a pen. What was the website again?
SQM research and look for the vacancy rates. Here's a postcode for you, 5114. You will see a vacancy rate 0.01%. Unbelievable. Okay, so what does that mean? It means that if you've got a rental property there, it's in high demand. What does high demand do? Drives up rental price. What does that rental price end up doing with this supply and demand? Capital growth. So it's a really, really important thing to understand these variables. And when we talk about this pie theory, the population growth is there. The infrastructure is diverse as well. So we've got so many different employment things that are happening there. And one thing that people might not know about South Australia is actually really big in mining as well. You got the Olympic Dam there is actually the largest open cut dam in the world. We've got a lot of lithium happening over in South Australia. Why is that important? The car that you're driving around today, it won't be there in 10 years' time. It will be electric, and all of these batteries are driven by lithium. All the batteries are run by lithium. So really important stuff to understand when you're looking at these markets. So Chris, we're about to start wrapping things up. I know we've got a couple of goodies. Okay, so before we get to that, I'm just going to say, anyone who's interested in any of the services that we've talked about today, property investment, learning more about these areas. What about finance? Our finance department here is one of the largest loan writers in Victoria, award-winning branch. These guys can get you some of the best rates. They can talk to you about the best structure. And more importantly, if you're not in a position now to invest, but you're looking to invest in the future, we'll help you get there, whether it's budgeting, whether it's mindset. Nikki in our Rev Money department is unbelievable at helping people get from here to here, making people understand what they need to do to be able to get themselves into a position to be able to do something sooner. So don't think for a second that we can't help you. It doesn't matter where you are in your working life, where you are in your career, we'll be able to help you at some point, okay? The next part is accounting. We've got a terrific accountant here in Gary. He can help you with your tax advice around any investment properties you might already have, whether that means that we're starting to think, okay, not much depreciation left in this one. Maybe it's time to do some renovations. Maybe it's time to unload on that one, as we talked about with sorry, what's that client's name? Sorry. We're talking about ones in Geelong. Right, I was going to call them Barbara. So we're going to look at what we could do there is to sell down those properties to invest in other ones. So good accountant is few and far between. Make sure you reach out to Gary. Financial planning, self-managed super funds, ensuring that you've got the best insurances in place, and just retirement planning, understanding what you need to be doing in order to get ready for that retirement. And then last but not least, if you've already got investment properties and you're sick of that property manager who never gets back to you, I assure you, have a look at our Google reviews. Our property management department here are one of the best in Victoria. We'd love to hear from you. So scan the QR code, book in a time to meet with our team. We'd love to meet with you. Obviously, no obligation to move to the next step. It all starts with the conversation. Before I hand over to Chris, my free gift, scan the QR code and you'll get a copy of my How to Identify Real Estate Hotspots. Again, a step-by-step guide on how we actually look to find these investment properties and the locations to buy them in. Remember, the suburb is going to do 80% of the heavy lifting for your investment property. So identifying the right spot is the most important tip that I can give you for today. Chris, over to you for your free gift.
Now, before I mention my free gift, like Tim said, even if your friends made money in an area, everyone's individual circumstances are different. Even if you can't get into the property market now, there might be options or avenues available to you to help you, or even ways to get there sooner. Now, for me, I really hope you take all this information on board. You read my Amazon best-selling book, which is a gift from me to you, all of my knowledge and all of my research. We stand by what we say. We stand by our product. I show you with my results with an open book there with 14 properties over 5 years. My team does that from accounting, from Gary to his team. You're working with some of the most passionate and awarded people in this industry. I look forward to meeting you and answering all your questions. Please read Tim's report and my book. Thank you very much for your time, and I look forward to building wealth together.
Chris, I'll just get you to share your, can you share your last slide, which is the gift from you for the QR code? It's on the screen for me right now because you're.
I will do my best. And there we go. And
there he is. There he is. He might know the best way to get a webinar moving with all these parts, but he certainly knows how to invest in real estate. I'll give you that. So we'll leave that on screen for a couple of seconds, and then we'll wrap things up. Chris, I really appreciate you taking the time to meet with us today. And as I said, I got a lot out of looking through that and seeing the success of that portfolio growth. And as I mentioned in the past, I don't think that's because you're a CEO that you've been able to do that. It truly is an incredible book that will step anybody through the guide to actually investing in real estate and growing your wealth. Download this, guys. I really do think that you're going to enjoy it. And as we mentioned, if you have any questions, we're always here to answer them. So thanks again, Chris. We'll wrap things up and look forward to seeing you already on the next webinar.
Absolutely welcome. Thank you, guys. Have a beautiful day.